So, the Indian stock market. You've probably heard the name a million times, right? But what is it really? In this explainer, we're going to cut through all that noise and give you a super simple, clear foundation for how the whole thing works. You know, have you ever seen one of those massive Indian companies and thought to yourself, man, I wish I could own just a tiny piece of that success? Well, that's exactly what the stock market lets you do. It's your chance to actually participate in the country's growth story. So let's start with the real basics. All right, so before we dive into the nitty-gritty, let's just zoom out for a second. At its heart, what exactly is this huge financial marketplace we're all so curious about?
Okay, so here's the simplest way to think about it. The stock market is basically a giant organized marketplace. But instead of buying, fruits or vegetables, you're buying shares. And a share is just a tiny, tiny piece of ownership in a company. So when you buy a share, you're literally becoming a part owner of that business. Pretty cool, huh?
And here's the really interesting part. It's a complete two-way street. For companies, this is how they raise money, what we call capital, to build new factories, hire more people, innovate, and just grow. And for regular folks like us, it's a powerful way to potentially build our own wealth over time. Right, so all this buying and selling, it's not just happening out in thin air, is it? There have to be actual places where all this activity is channeled. And that brings us to the two giants of the Indian market. In India, almost all the action is concentrated in two major hubs. Think of them as the twin pillars holding up the entire structure. And these are the BSE, which is the Bombay Stock Exchange, and the NSE, the National Stock Exchange. Just about every trade you hear about happens on one of these two massive, fully electronic platforms. This table breaks them down perfectly. You've got the BSE on one side. It's the old-timer, Asia's very first stock exchange, and it's known for having the highest number of companies listed. Then you have the NSE, the newer, more tech-savvy player. It's famous for its high liquidity, which is just a fancy way of saying tons of shares are being bought and sold, making trading super fast and easy. And get this, 1875. That is just incredible when you think about it. India has had an organized stock exchange for well over a century, long before computers or digital trading was even a dream. Okay, but with literally thousands of companies listed, how on earth are you supposed to know if the market as a whole is having a good day or a bad one? You can't possibly track them all, right?
Well, this is where a super important tool comes into play. We need a way to track the market's pulse.
I absolutely love this analogy because it's perfect. An index is like taking the market's pulse. It doesn't tell you about every single cell in the body, but it gives you a fantastic snapshot of its overall health and direction. Is the pulse strong? Is it getting stronger? That's what an index tells us.
The two big ones you'll hear about on the news every single night are the Sensex and the Nifty 50. It's really simple. The Sensex tracks the top 30 powerhouse companies on the BSE, and the Nifty 50, you guessed it, tracks the top 50 big players on the NSE. So when you hear the market is up today, they're almost always talking about one or both of these indices climbing higher.
Okay, so we know where the trading happens, on the exchanges. But it's also really important to know that there are two different arenas, or types of markets, where these shares get traded. Think of it like this. The primary market is when a company has its grand opening. It sells its shares to the public for the very first time through something called an IPO, or initial public offering. But once those shares are out in the wild, they get bought and sold between investors like us every single day. And that all happens in the secondary market. That's where all the daily action is. Now, with so much money changing hands every second, you have to wonder, who's the referee here? Who is making sure nobody's cheating and that the whole game is being played fairly? And that is where the official market regulator steps in. This is a big one. And that referee, the official watchdog of the entire system, is SEBI, the Securities and Exchange Board of India. They're the government body that sets all the rules of the game for companies, for brokers, for everyone. But their number one, most important job is to protect the interests of everyday investors like you and me from any funny business. All right, so we've got the playing field. We know the main players, and we know who the ref is. So what about you? How do you actually get in the game? What's your ticket to entry? Well, getting started really just requires setting up a few key things, which together act as your personal ticket to trade. It really just boils down to these 3 essential accounts. First, your normal bank account. That's for moving your money around. Second, a trading account. You open this with a stockbroker, and this is the account you use to actually hit the buy and sell buttons. And third, you need a Demat account. The best way to think of this is as a digital locker or a vault where all the shares you buy are held safely in electronic form.
And there you have it, from the huge exchanges and the indices that track them, all the way down to the accounts you need to get your foot in the door. You now have the basic map of the market. So the only real question left is, where are you going to explore first?